Most people destroy their real estate returns not because they pick bad investments, but because they keep chasing the next shiny property instead of building one simple system that pays them forever. Here's the idea. If you structure your real estate wealth around just 4 carefully chosen REITs, you don't need to guess where interest rates are going, you don't need to become a landlord, and you definitely don't need a spreadsheet with 27 tickers to feel diversified. You need 4 engines, all pulling in the same direction: growth, stability, innovation, and compounding. Once those are in place, your job stops being prediction and becomes repetition. You just keep feeding the machine. Think about how most beginners approach real estate. One day they're obsessed with residential rentals. Next week it's data centers. Then it's, bro, industrial is the future. Their portfolio isn't a strategy, it's a graveyard of half-finished ideas. They buy a bit of everything, understand almost nothing, and wonder why their wealth graph looks like a heart rate monitor instead of a steady upward line. REITs expose that problem brutally because there are hundreds of them, all with glossy presentations and fancy narratives. Without a clear framework, you're lost. So create a framework that doesn't care about noise. Call it your 4 engines of real estate wealth. One engine drives long-term appreciation. One absorbs shocks and keeps the income smooth. One pushes returns higher when conditions are right, and one takes all that cash flow and turns it into a relentless compounding machine. Once you see REITs through that lens, individual tickers stop being exciting stories and start being tools. If a REIT doesn't clearly fit one engine, it doesn't belong in your core. Simple as that. To make this work, you first need to understand what a REIT actually is. Not the textbook answer, but the economic reality. OREIT is a pass-through machine for rent. It owns or finances income-producing properties, collects rent from tenants, pays its expenses, and is legally required to send most of the remaining cash out to shareholders as dividends. When you buy a REIT, you're not just buying a stock, you're buying a slice of a portfolio of buildings and the rental contracts attached to them. You're converting tenants' rent checks into your cash flow. That's an entirely different game from betting on share prices. That difference matters because stocks live and die by sentiment, while REITs are anchored in contractual reality. A software company can have a great story and still go nowhere. A REIT with high occupancy, long leases, and solid tenants is not a story. It's an operating business that gets paid month after month. The market can misprice it for a while, but tenants still owe rent. If you're tired of watching your wealth jerk up and down based on headlines, this is your way out. You're no longer depending on someone else to pay a higher price for your shares. You're getting paid because the real world keeps needing space. That's the second key piece: permanence of demand. The modern economy runs on square footage. People need places to live, companies need places to operate, and goods need places to move and be stored. REITs sit right in the middle of that. As long as humans exist in cities, there will be demand for housing, logistics networks, medical facilities, and specialized spaces. That doesn't mean every REIT is safe, but it does mean the asset class itself is built on something more durable than hype cycles. You are tying your wealth to how the world actually functions, not just to what's trending on financial Twitter this week. Now, why not just hold a big REIT index and call it a day? You could. Many people do, and they'll be fine. But fine is not the goal. The problem with broad indexes is that they don't care about role, only representation. They own everything: the excellent, the mediocre, and the outright fragile. There's no intentional design behind what each holding does for your life. You, on the other hand, are not building an academic portfolio. You're building a personal cash flow engine that needs to deliver clarity, emotional control, and a rising stream of income. That demands focus. Simplicity with structure is where real strength comes from. Owning 20 or 30 REITs does not make you safer. It just makes it harder to know what's happening or why. True diversification is functional, not numerical. If you own 4 REITs that each serve a different purpose and are built on different underlying economic drivers, you're more diversified than the person with 25 overlapping positions that all crash together when one sector gets hit. The 4R REIT system works because nothing is there just because. Each one is a deliberate choice. So here's the big promise of this script. By the end, you'll know how to build a 4R REIT portfolio where every piece has a clear role, and you'll understand that your edge is not secret information but ruthless simplicity. You'll see why you don't need to predict rate cuts, guess cap rates, or time real estate cycles. You only need to keep feeding 4 engines that are designed to handle different environments. When rates rise, one engine slows, another keeps things moving. When growth accelerates, a different engine takes over. Your job is not to be right every quarter. It's to never be forced out of the game. Start with the growth engine. This is your long-term driver, the REIT, that steadily increases its cash flows and asset base over time. The goal here is not drama, it's compounding scale. You're looking for characteristics like high occupancy, a history of expanding rental income, disciplined acquisitions, and exposure to property types with secular demand. Things like logistics, mission-critical infrastructure, or high-quality residential. The growth engine doesn't have to pay the highest yield today, but it must show a clear pattern. More properties, more rent, more value, year after year. Most investors get this part wrong because they confuse price spikes with growth. A REIT can rally 30% on sentiment and still be a weak growth engine if the underlying business is crawling. What you want is boring consistency, management that reinvests intelligently, properties that stay leased, and tenants who renew because moving would be painful. Over a decade, that sort of REIT can quietly double or triple its cash flows, and your share of those flows rises with it. In this system, that's the engine that keeps pulling the portfolio forward, even when nothing exciting is happening in the market. Next comes the stability engine. This one exists for a single purpose: to make sure your real estate income doesn't fall apart the moment the economy or interest rates wobble. Stability REITs usually have long-term leases with strong tenants and predictable rent escalations. Think properties locked in with government agencies, blue-chip corporations, healthcare systems, or other tenants that simply cannot afford disruption. The yield here may be solid, but the real value is reliability. When markets panic, this is the engine that keeps humming in the background, letting your compounding process continue uninterrupted. The psychological benefit of the stability engine is enormous. When rates spike or headlines scream about the death of real estate, this REIT becomes your anchor. You see rent still being collected, dividends still paid, occupancy still high. That calmness is not abstract. It prevents you from panic selling your growth or innovation engines at the worst possible time. Stability is not about maximizing return. It is about defending your decision-making. Without it, you will eventually sabotage yourself. Then comes the innovation engine, the one most people underestimate. Innovation in real estate isn't about some flashy tech gimmick. It's about business models that unlock new types of demand, improve capital allocation, or scale faster than traditional property owners. These REITs might focus on specialized properties like experiential retail, cutting-edge logistics, modern net lease structures, or other models that capture emerging patterns in how businesses and consumers use space. The cash flows can grow faster, but they require more thought and selectivity. The innovation engine is your accelerant. When the economic environment is supportive, stable or falling rates, healthy demand, expanding tenants, this REIT can outgrow the rest of your portfolio and meaningfully pull your total returns higher. But you don't rely on it for survival. That's the beauty of the structure. If innovation slows or a niche hits a rough patch, your stability and growth engines still carry most of the load. Innovation doesn't have to win every year, it just needs to win big over time. Finally, there is the dividend engine, the one that turns everything else into visible, tangible progress. This is the REIT chosen primarily for its income characteristics: a strong starting yield, consistent dividend payments, and a track record of raising that dividend over time. It doesn't have to be the fastest grower, but it must be dependable. You want a dividend that isn't a marketing stunt, but the natural result of healthy cash flows after expenses and maintenance. This engine powers your compounding. Every quarter, the dividends from all 4 REITs show up, but the dividend engine tends to be the workhorse. If you're reinvesting, those payments automatically buy more shares, which then generate more dividends, which buy more shares, and so on. Over a decade or two, this is how modest contributions turn into something that looks unfair to anyone who only focuses on price charts. The dividend engine doesn't just pay you, it multiplies your ownership. Put all 4 together and you have a self-reinforcing system. Growth builds the underlying value of your real estate exposure. Stability keeps the cash flows resilient. Innovation gives you upside in good conditions. Dividends turn all of that into a compounding machine you can see in your account statements. When one engine slows, maybe rising rates hurt valuations or a niche sector cools off, another engine keeps your portfolio pulling forward. You don't need to guess which one will lead next year. You only need to make sure each role is filled by a REIT that truly deserves to be there. At this point, the obvious question is, okay, but why exactly 4? Why not 3 or 10? Because 4 is the smallest number that lets you cover the full spectrum of what you actually need from real estate: appreciation, defense, acceleration, and cash flow multiplication. With fewer, you start combining roles and increasing your dependence on any one outcome. With more, you start diluting your focus and losing the ability to really understand what each position is doing. 4 forces you to make serious choices and say no to almost everything, which is where most of the edge in investing lies. The beauty of the 4 REIT system is that it turns your portfolio from a list into a blueprint. Most investors think in tickers. You'll start thinking in functions. Instead of asking, should I add this new REIT? You'll ask, which engine does this belong to and does it clearly upgrade that role? If the answer is fuzzy, you don't add it. That simple discipline protects you from style drift, emotional reactions, and the temptation to chase whatever's trending in the REIT space this month. Now let's address the fear that stops many people from touching REITs at all: interest rates. Whenever rates rise, the same storyline shows up. REITs are dead in the short term. Yes, REIT prices are sensitive to changes in rates because they affect valuations and financing costs. But zoom out. A well-run REIT is not a bond. It's a business that can raise rents, renew leases at higher levels, and buy properties at better prices when others are scared. The growth and innovation engines especially can adapt over multi-year periods. The stability and dividend engines are built explicitly to keep your cash flows intact while that adaptation happens. What really destroys our REIT investors is not rates, it's behavior. Chasing yield without understanding tenants. Panic selling because a headline said commercial real estate crash, over-concentrating in one flashy subsector. The 4 REIT framework is an antidote to that. You're not hopping between themes. You're slowly increasing ownership in 4 well-chosen, well-understood businesses, each with a job to do. When the market hands you discounts, you don't freeze. You simply buy more of whichever engine is most attractively priced relative to its long-term cash flows. Another advantage, REITs let you bypass the headaches that make direct real estate so intimidating. No tenants texting at midnight, no surprise roof replacement bills, no legal drama because someone slipped in the lobby. Professional management handles all of that, and you share the results at scale. This matters if you're busy building a career, a business, or other investments and don't want your life dominated by property management. You still tap into the economic power of real estate, but with far less friction. There's also a tax and liquidity angle. Depending on your country, REIT dividends may be taxed differently than regular income, and you can hold them inside tax advantage accounts where the compounding happens more efficiently. On top of that, you can adjust position sizes with a few clicks. Compare that with selling a physical property, listings, negotiations, fees. With REITs, you can tilt between engines gradually in line with your plan, instead of making all or nothing moves that disrupt your life. So how do you actually implement this without turning it into another overcomplicated project? Start by writing down, in plain language, what each of your 4 engines is supposed to do. Not tickers, functions. This one is my long-term growth driver. This one protects my downside and keeps income steady. This one rides secular shifts in higher growth. This one pays me reliably and boosts compounding. Only then start matching specific REITs to those roles one by one. When evaluating candidates for each engine, look at the basics: property types, tenant quality, lease lengths, balance sheet strength, dividend history, and management's track record. You're not hunting for perfection, you're hunting for coherence. Does the growth engine candidate consistently increase funds from operations and assets? Does the stability engine candidate avoid concentration in weak tenants? Does the innovation engine have a clear, scalable model instead of a vague story? Does the dividend engine pay from real cash flow rather than borrowed money? Once you've chosen your 4, the hard part isn't analysis, it's discipline. Set simple rules. Decide how much of your portfolio each engine will represent. Decide how often you'll add new money, monthly, quarterly, and how you'll allocate it. Maybe you add evenly at first, then tilt new contributions toward whichever engine is temporarily out of favor. The key is that you're acting according to a structure, not your mood. Every deposit is a vote for long-term wealth, not short-term excitement. Over time, something subtle but powerful happens. You stop obsessing over individual price moves and start tracking the health of the system. Are dividends growing? Is occupancy strong? Are leases being renewed? Are debts manageable? When your attention shifts from price to process, you become far more dangerous as an investor because you're no longer easy to shake out of good positions. That's when the compounding really starts to show, because you're finally giving time the chance to do the heavy lifting. The biggest shift this 4 REIT approach creates is psychological. You move from "what should I buy now" to "how can I keep feeding this machine?" That sounds subtle, but it's everything. It turns investing from a series of stressful decisions into a routine. Contribute, allocate according to your blueprint, ignore noise. You may still check prices, but they no longer control your behavior. Your identity switches from hunter to builder, and that's the end game here. Not to impress anyone with obscure REIT picks, not to gamble on macro calls. The real prize is a portfolio that quietly converts global real estate activity into your recurring cash flow, month after month, year after year. A handful of well-chosen REITs, each with a defined purpose, can do that. You don't need to own everything, you just need to own the right 4, and then have the patience to let them work while everyone else keeps overthinking real estate investing.